Welcome to the Deep Dive. We're your shortcut to getting really well-informed.
Ready to dive in?
Okay, so today we are plunging into the latest economic and market news. We're covering, Tuesday, July 22nd through Monday, July 28th, 2025.
Right?
And our mission, like always, is to pull out the most important nuggets of knowledge from the sources we've looked at, give you that edge.
Mm-hmm.
We've got a pretty fascinating main theme today. This really remarkable streak of record highs for U.S. stocks. What's jumping out at you right away?
You know, it is exactly that streak. It really stands out. What's fascinating here, I think, is how all these different pieces, the economic data, the market moves, how they're kind of fitting together.
Right.
It paints a pretty clear picture.
Yeah.
And understanding these movements and, what's underneath them, that's crucial for anyone who wants to really grasp the current trends and, what they mean more broadly.
Indeed. And yeah, when we talk about market movements, the headline this past week, you can't miss it, is that impressive run for U.S. stocks. The S&P 500 stock index, for example, just hit, 6 consecutive record closes?
6 in a row. Yeah, incredible.
And the NASDAQ wasn't far behind. It also saw 4 straight days of record closes.
Mm-hmm.
But here's something interesting about this run, right? Despite hitting these records day after day, the actual daily price increases were, pretty modest. All of them were less than 0.8%.
That's a great point.
It feels more like a steady climb, not a sudden surge. What does that sort of slow and steady thing tell you about maybe investor thinking or market strength?
That's a really astute observation, this kind of calm ascent. We've seen market volatility, the VIX.
The fear gauge, yeah.
Exactly. It's really plummeted, especially since April 2nd. Some people are calling that Liberation Day now.
Okay.
The VIX dropped way back down to 15%. Remember, it spiked over 50% back in early April.
Wow.
So 15%, that's its lowest level all year. And that kind of calm, it tells us something important about how investors are feeling right now. Pragmatic optimism, maybe.
Pragmatic optimism. I like that.
Mm-hmm.
And what makes it even more compelling, I think, is how broad this positive performance was.
Absolutely.
It wasn't just one or two sectors. We saw decent gains pretty much across the board. Large cap stocks up 1.3%, small caps up 1.1%.
Your growth value.
Yep. Growth stocks rose 1.4%, value up 1.2%, and the NASDAQ itself up a solid 1.0%. So it's not just, a handful of big tech names pulling everything up.
Exactly right. It's very widespread confidence we're seeing. And this market optimism, you could see it reflected in other assets too.
Oh, yeah? How so?
Well, look at gold. Gold usually likes volatility, uncertainty, bad news, right?
Right.
It actually fell 2.3% over the week.
Whoa. Right.
While the U.S. dollar, which, tends to like calmness and stability, it strengthened by 1.3%.
Interesting contrast.
It really is. And it raises, I think, a really important question for us. What's actually fueling this widespread sense of calm and optimism in the markets?
That is the million-dollar question, isn't it? Okay, let's try and unpack that. What are our sources suggesting is really behind this period?
Well, our sources seem to highlight 2 main reasons. First, there's a lot more clarity now around tariffs.
Oh, okay.
We're seeing more deals getting announced. There was a pretty critical agreement between the U.S. and the EU, for instance.
Right.
And that just brings a bit more certainty to the whole global trade picture, which the market likes.
Less guesswork.
Exactly. The second big factor is earnings season. We're right in the thick of it.
Yep.
About a third of the S&P 500 companies have already reported their results.
Mm-hmm.
And get this, another 164 companies are set to report this week.
Wow, busy week for earnings, too. Any big names?
Oh, yeah. We're talking the tech giants, Apple, Amazon, Microsoft, Meta.
Yeah.
They're all on the docket.
Okay. So for you listening, those upcoming earnings reports, especially from these massive influential companies, they're going to be really critical.
Absolutely critical.
They'll basically tell us if the current market optimism and that low volatility we talked about, if it's really justified. And if it's likely to stick around, like a mid-season report card for the market.
Well put.
Okay, let's shift gears slightly. Let's talk about the upcoming economic calendar. Because if last week felt maybe a little light on data, this week looks absolutely packed. It's definitely making up for it.
You are not wrong there. It's jam-packed. So for you keeping track, here are the key economic reports and what people are generally expecting.
Wait on us.
Okay, first up, consumer confidence. We get 2 big reads. The Conference Board's number is out Tuesday, and the University of Michigan's is on Friday.
And the expectation.
Both are expected to show some improvement compared to the last readings.
And why do these consumer confidence numbers matter so much again? Just remind us.
Sure. They matter because they give us a really crucial peek into how consumers are feeling. Are they optimistic? Pessimistic? And that often translates into their spending plans.
Got it. Consumer spending drives a lot of the economy.
Exactly. Okay, then on Wednesday, we get the first estimate of second quarter GDP, gross domestic product.
The big one. Like the economy's main report card for the quarter?
Pretty much. And it's expected to show a pretty strong recovery from the first quarter's GDP number.
Which was kind of weird, right? Because of the tariff stuff.
Yeah, you remember that Q1 number was hit by companies basically importing stuff early, trying to buy ahead of potential tariffs.
Okay, makes sense. What else?
Thursday brings a really critical read on inflation. We get the PCE price index.
Ah, the Fed's preferred measure.
That's the one. And, it's expected to show a jump from the prior month, kind of mirroring what we saw with the CPI inflation number a couple of weeks back.
Okay. Inflation's still sticky.
Seems that way. And then Friday, it's a double header. We get the big jobs report.
Always important.
Critical. Expectation there is actually for it to be a bit weaker than last month's report.
Weaker jobs. Okay.
But also on Friday, we get the ISM report, and that one is expected to show some improvement. So a bit of a mixed bag on Friday.
Wow. Okay, that is a lot of data packed into one rint.
Told you.
But beyond just the data releases, there's also a huge event happening Wednesday, right?
Yeah.
Everyone's going to be watching the Federal Reserve.
Oh, absolutely. It's Fed decision day for July. That's pivotal.
So what's the market thinking? What are the expectations around Fed policy right now?
Well, right now, very few people expect a rate cut in July. Like, the odds are only around 3% or so.
Okay, so July's probably a hold. What about later in the year?
Looking out for the rest of 2025, a solid majority, maybe 80%, they're expecting rate cuts. But not huge ones, no more than 50 basis points total.
So maybe one or two small cuts max for the whole year.
That seems to be the consensus building. And what's really interesting is the rising probability that any cuts will be even smaller, like just 25 basis points, or maybe none at all.
Oh. How much has that probability changed?
It's now up to 37%, which sounds okay, but compare that to the end of June, it was only 6.3%.
Wow, that's a big jump from 6% to 37%, thinking maybe only one small cut or none.
Huge jump. It really shows the market is kind of dialing back its expectations for big Fed cuts, becoming more cautious.
So that tells us that all this heavy economic news coming out this week,
Yep.
and whatever the Fed officials actually say publicly,
Crucial.
it's going to massively influence those expectations one way or the other.
For sure.
So what does all this mean then for how the Fed might guide us through the next few months, and how does it tie into other markets like bonds?
Well, connecting it to the bond market, we actually saw bonds fall slightly over the past week. They moved in the opposite direction of stocks.
Okay, why is that?
Often happens when the stock market's doing well. It suggests maybe there's less immediate need for the safety of bonds or less expectation of imminent rate cuts, which would boost bond prices.
Got it.
But, and here's the connection to this week's data, a surprise on that PCE inflation number on Thursday.
Yeah.
That could definitely shake things up. It
Yep.
could cause stocks and bonds to suddenly move together again, probably downwards, because neither market really likes upside inflation surprises.
Right, inflation fears hit both. Makes sense.
Mhm.
And where did bond yields end up?
Good question. The yield on the benchmark 10-year Treasury note, it rose about 4.8 basis points over the week, closed at 4.42%.
Okay, 4.42% on the 10-year. Got it. Let's zoom out a bit now. What about the global picture? How did world stock markets do compared to this pretty strong run in the U.S.?
Yeah, good perspective to bring in. Globally, it was a bit more muted. Developed market stocks were up, but only about 0.5%.
Okay.
And emerging market stocks actually dipped slightly, down 0.4%.
So both underperformed the U.S. market gains we saw.
Correct. And part of that underperformance, at least for U.S. investors looking at international stocks, is because the U.S. dollar strengthened.
Ah, the currency effect.
Exactly. When the dollar gets stronger, those returns from foreign stocks are worth less when you convert them back into dollars.
Right, that makes sense. Okay, so let's try and wrap this up. Let's recap the key takeaways from this deep dive.
Sounds good.
We've seen this really impressive streak of U.S. stock market highs, but it was a steady, broad-based climb, right? Signaling maybe deeper investor confidence.
Driven, it seems, by more clarity on tariffs.
Right. And this really crucial earnings season that's hitting its peak right about now.
Mm-hmm. And all of this is playing out just before a week that's absolutely jammed with key economic data.
And of course, that Fed meeting on Wednesday, with the Fed looking like it's treading pretty carefully, watching the data.
Exactly right. And understanding how all these things connect the data, the Fed, Earnings, tariffs, market sentiment, that's really the key, isn't it? To navigating today's, well, pretty complex economic landscape.
Couldn't agree more. If those actual numbers, say for consumer confidence or GDP or maybe that jobs report, what if they come in significantly different from what everyone expects right now?
Good question.
Something to mull over until our next deep dive.